going to be our last lecture on social insurance. And I'm basically going to talk about empirical work on two other very important social insurance programs, which are workers' compensation and disability insurance. So we'll start with workers' comp, which is a big program in the US, I think on the scale of about $100 billion a year, that provides insurance against injury at work. And it covers both lost wages and medical benefits. And there are various rationales for government intervention here that are similar to those we've talked about with unemployment insurance. So the market may fail due to adverse selection. There could be behavioral issues like workers are unaware of risks on the job and don't buy adequate insurance if you rely on them to purchase it. And I think the thing that actually matters here, and what was the actual origin of the system, is litigation costs. So the way workers' comp was one of the first social insurance programs introduced in the US, and the reason for it was that prior to the existence of this insurance system, people would sue whenever they got injured, and there were lots of injuries in manufacturing plants and so forth. And so that was inefficient in the sense that people figured you could have a systematized set of rules about what happens rather than having these repeated court cases. And so there's sort of like a transaction cost reason to have a fixed set of benefits rather than go through these lawsuits. And so what you get from that is actually it's a state level program, so there's substantial variation in benefits across states for different types of injuries, and there literally is a specification of what each type of injury gets you in terms of benefits. So this table, which is from Gruber's textbook, shows you sort of the price of various different things that can happen to you. Like if you have, for instance, in Illinois, if you lose your arm while you're at work, that is, you get a benefit of $300,000. Whereas in Indiana, you only get $86,000 for your arm. In contrast, for other things, it's like totally different across the state. So there's tremendous variation across states for these different body parts, while that, so that is the more sort of gory part of the table. The thing that's actually more important from a dollars point of view is the last column, which are temporary injuries. So the most common injuries are not permanent injuries like this, but you hurt your back or something and you're out for a few weeks of work. And that's where most of the money ends up going, these temporary injuries. And there it works, it's very similar to UI. You get a benefit per week that depends upon your past earnings, and then you get some coverage, typically actually almost complete coverage of your health costs, okay? So naturally a program like this, because of the tremendous state level variation and the changes over time, suits itself well to pretty good empirical work. So we're going to talk about that in a second, but essentially the literature is mainly empirical, not just because you can identify the relevant parameters well, but the theory is quite similar to what we've discussed before. Do they what? Yeah. So do you mean do you get health insurance? Yeah. No. So that's part of the program, right? That's a big part of the program that they cover the health expenses in addition to the lost wages. Okay. So the lost wages, the way it works typically is like UI. You get half of your prior wage while you're out of work, but that varies across states with caps and stuff, which we'll talk about in a second. And then typically you get like 100% of your medical expenses covered, I think up to some limits or something. The insurance health insurance is a reimbursement. These are lump sum transfers if you have like a permanent disability like this. But as I was saying, the more common thing is the temporary injury, where the wage benefit that you get is not a lump sum. It's proportional to how long you're out of work, exactly like for UI, right? And so that's going to create disincentive effects and stuff. Yeah. I think it's where you are working. I'm almost certain it's where you're working because it's a workplace level. The insurance policy is actually being taken out by the firm, and it's all through the workplace. I'm almost certain it depends upon where you work. I haven't seen it. That actually would lead to a good research design, which I haven't seen anybody exploit. Yeah, Illinois, Indiana, exactly. You'd have people working on the two sides of the border and stuff. And presumably people are not sorting on the basis of these benefits, I would hope. Okay, so the theory of workers' comp is formally very similar to that of to unemployment insurance. I'm not going to talk about it at all, actually. So if the probability of injury can't be controlled, okay, so let's say whether you get hurt or not is not something that's elastic to the level of benefits, which was probably a plausible starting point. And so then the only margin of response is how long you stay out of work. Then it's actually totally isomorphic to the type of models we've been talking about, because whether you call the decision job search or how quickly you heal and come back to work, it's mathematically basically the same thing. Obviously, some features of it are different, like there's no reservation wage choice and stuff like that, but essentially the derivations are the same. If the probability of injury can be controlled, then you can see how you have to modify the model to take into account not only the amount of time you're out of work conditional on getting injured, but how the probability of injury responds to the level of benefits. And I think the more plausible channel here is not that the worker himself somehow becomes less careless, but you could see companies investing less in safety precautions if you're in an environment where you're very well insured relative to when you're not, right? And then, so you know how in these models we always have this convex cost of search effort. So what is that here? You can think of that as, you know, exactly coming to this question. If you take more time to come back to work, that has some benefit because it's hard for you to work when you're injured and maybe you heal more or whatever. So all of that is going to get captured in that convex function, which is controlling the benefits of staying out of work, okay? So, you know, you can work this out if you're interested mathematically. I'm not going to do that here, but you're basically going to get the same types of formulas. What matters are things like consumption smoothing benefits, the curvature of utility, the elasticities of time out of work with respect to benefits and so forth. Okay, so I'm going to show you three sets of empirical evidence, most of which are on the distortion side of the program because we have very little to say actually empirically on the benefits of the program. It's one of the weaknesses of the literature to date. So the first thing I'm going to show you is some work on what's called Monday effects and impacts of the program on worker behavior. Then we'll talk a little bit about firm-side responses, and then we'll talk about the fact that it's a mandated benefit and what that does to equilibrium wages. Okay, so here's the simplest evidence that workers' comp actually has some effects on reported injuries and seems to create some moral hazard. So if you plot just reported workers' comp claims by type of injury, by day of week, you see this striking pattern called a Monday effect, which is that people tend to have a lot more back injuries on Monday relative to other days of the week. And other injuries, which you would think are probably better reported, like burns and cuts, have no pattern across the days of the week, right? So what's the idea here? Back injuries notoriously are the hardest thing for physicians to verify. And so you see the same issue, like the tremendous growth in disability insurance and workers' comp is driven by a combination of back pain and mental health issues, both of which could legitimately be changing, but also could, you know, are easier to manipulate reporting than these other things, okay? So that's just direct evidence that suggests that something, there might be some reporting effect. So now what do we think is actually going on Monday? So what's explaining this? I mean, that's not per se that interesting from a policy point of view, but you know, you might be curious. So there's this paper by Card and McCall in 1994 that asks if weekend injuries lead to the Monday effect. So what's the logic here? Suppose you get, you know, you hurt your back playing football over the weekend or whatever, and you don't have private health insurance, which many people don't, in this population especially. Then what is the optimal thing to do? Well, you want to see the doctor, but you don't want to pay for it. So you come to work on Monday and then say you hurt your back. And so you'll see an extra incidence of reported injuries on Monday relative to the weekend, right? If it's driven by, you would think if this is a health insurance effect. So what's the obvious way to test that? They look at uninsured workers versus insured workers, so people who have private insurance versus people who don't, and draw that same chart for the two groups, right? And although your hypothesis based on the explanation I was just suggesting might have been that you'd see a bigger Monday effect for the people who are uninsured, you don't in fact find that in practice. Okay, so this is actually like a negative paper in the sense that they say this appears not to be driven by health insurance. So what else could be going on? You know, I don't have a clear sense of what it is, and I don't think anybody's really worked on this carefully. But one potential explanation is that if you want to get extra days off, what's the optimal time to report an injury? If you think that you're going to be out of work for 5 days, you'd want to report it on a Monday rather than a Wednesday, so that part of it gets absorbed in the weekend or something, right? So I don't think this per se is really like a deeply interesting phenomenon to figure out. What it suggests is that incentives could potentially matter quite a bit, and so that leads to work actually studying how changes in benefit levels affect the number of claims of injury and affect the duration of injuries, all right? So one of the best papers in this literature is by Meyer, Viscusi, and Durbin in the AER in 1995, which implements a DD analysis for workers' comp durations. And they find large effects on durations using reforms in Michigan and Kentucky. So this is a standard DD analysis like the UI stuff. I think it's pretty compelling. So let's briefly go through this. So the way the workers' comp schedule works is just like the UI schedules, where there's a replacement rate up to some cap. And then that cap gets moved around as states make their systems more generous over time. So let's focus on the case of Kentucky. They look at this reform, I think it's in the late 80s, where the cap was raised in Kentucky. And what that does is for the people who have high earnings, it raises the replacement rate from 30% to 50%. So this is the wage replacement rate after you get injured for a temporary injury. And if you look at the low earnings guys, they were getting 66% before, and they're getting 66% after because the cap is not binding for them. Okay? So that's naturally the control group. So they do a difference in difference analysis comparing the changes in durations of injuries for high earnings and low earnings guys before and after the increase, exactly as you're familiar with. And the results that they focus on are in these boxes here where they look at medians, but I want to make just a quick methodological point here, which is useful in many contexts, which is actually let's start by looking at the mean durations, all right, rather than the median. And so we see the high earnings guys, this is the treated group after the increase. They have 12.9 weeks of time out of work on average, 11.1 before, so it looks like there's some increase there. There's also some increase for the low earnings guys, so then you compute the two differences and then the diff in diff, okay, and you get an estimate of about a week increase. But notice that the standard error is 1.28, right? So your confidence interval is quite wide. It spans basically -1 to 3, and so you don't have the precision to say whether the change in workers' comp benefits actually raised the duration, the injury duration significantly or not. Okay, so if you now turn to the median and do the same analysis, so just plot this is like a quantile regression, right? Looking at the 50th percentile. So look at the median for the high earnings guys before. It was 4 weeks, 5 weeks after. For the low earnings guys, the median stays at 3. Compute the diff and diff, and now you get an estimate of 1 week again, but the standard error is 0.29, right? So now you have a t-stat of 3. It's highly significant. You have a much, much tighter confidence interval. So that is a pattern you'll very commonly see in empirical work, which is if you look at certain moments of the distribution, especially means, because they're so influenced by the tails, there are few guys who have super long durations, you are going to tend to find unstable things. So you always see this, for instance, in studies of earnings impacts of policies, or really, many outcomes have a lot of noise, and they have outliers. And so in any of the papers we write, we end up either looking at moments like this, like medians or thresholds, or you end up trimming the variable in some way to deal with the fact that you have a lot of extra noise. So I think that's a useful thing to keep in mind, because usually you start by running an OLS regression, and you might find something, but inevitably it'll be pretty imprecisely estimated, and there's a lot to be gained from figuring out, from basically studying other moments of the distribution that are more stable. Yeah, so the other way of looking at this is you actually can't do very precise inference on the mean. That's what you're learning here, because you have fat tails and you can't say much about the tail. However, so there are a couple different ways of looking at this. Is it obvious that the mean is the treatment effect of interest? You know, not necessarily. If you want to know like how much the typical guy is staying out of work, it's possible that you actually care about what happens at the 50th percentile, right? The other way to look at it is, suppose you make an assumption that the treatment effects are constant, okay, or like log constant or something across the distribution. Then you might not have the power to look at the mean and figure out what that constant, that proportional treatment effect is. But with the median or some other statistic, you might actually be able to figure that out. And then if you're willing to make the assumption that in the tail, the treatment effect would have been the same, say, in percentage terms, then now you can actually say something about the whole distribution. Obviously, that relies on a stronger parametric assumption. The other way to do this, which they don't do, but I find useful, is so this is a quantile regression because you are looking at a order statistic on the left-hand side, essentially. And quantile regressions are hard to interpret and also very slow to run. So to fit on big data sets, this is not, you typically do not want to look at medians. So the other way to implement this, just from a practical point of view, is pick a threshold, like define a threshold. So suppose the median is 4 weeks, right, and the sample as a whole. What fraction of people have durations of more than 4 weeks? So that's a statistic that you can just, define an indicator for having a duration of more than 4 weeks and put that on the left-hand side and do an OLS regression. So now you have all the advantages of OLS, and you're basically asking what is the impact of the treatment on the probability that you get pushed over that 4-week threshold. And then you can convert that, again, based on what I was saying, if you assume that the distribution is shifting in a certain constant way, you can convert that into the parameter you're trying to identify. So that's also, I think, thresholds are a very useful technique. Yeah?
How do you decide which threshold?
Yeah, that's also a good question. So really the way to think about it is you can recover the whole set of treatment effects across the distribution by varying that threshold, right? Usually what you'll find empirically is if you have thresholds in the far tails, you'll get massive standard errors because you basically have no precision there. So usually what we start with is threshold around the median, and then if you think there are really heterogeneous treatment effects, you can kind of figure that out by varying the threshold. Okay, so what's the substantive point of this paper? Durations go up, fairly significantly, actually. And the other point that they make here, again, they look at median medical costs. You can see medical costs have this property as well, where you're going to have tremendous skew in that distribution. Do a diff and diff on medical costs, and you basically get nothing. So what's the idea of this? People are taking longer to come back to work when the benefits go up, but they do not have more severe injuries in the sense that if their injuries were actually worse, you would see that showing up in terms of them getting more medical treatment, right? But they're not. And so that suggests that this is, a moral hazard sort of response, or that's what they want to argue. Okay, yeah.
Is that last result?
Okay, so that's a quick bit on worker responses. There are more papers like that, but they basically have similar feel. Okay, so then the firm side responses in this literature. As I mentioned, if you buy insurance, so the issue here is whether the firm is self-insuring or whether it's buying insurance. So if I buy insurance from a big insurance company, so let's say I'm a small business, I don't want to deal with the workers' comp risk on my own, within my own firm, so what do? I contract with a big insurance company which is selling a lot of these policies, and so they insure me, but the premium they charge might vary depending upon how many injuries I have, right? So you can imagine the insurance company, they're not going to perfectly experience rate you, because if they did, then they essentially would not be offering you insurance, right? So there's like a partial experience rating that happens in equilibrium. And that's going to generate these issues of firm-side moral hazard, where if I'm partially insured, I'm going to underinvest in safety in the workplace. Now, if you have a self-insured firms, you would think the incentives to improve safety are stronger, and they also have an incentive to ensure that workers return to work more quickly because they're directly bearing the cost of the worker being out of work. So you can study this question as well empirically, right? You can ask how important are these firm-side distortions, and Alan Kruger does that in a paper in 1990, where he essentially compares the behavior of self-insured firms with firms that have arm's-length insurance. And he finds that self-insured firms do in fact have workers who stay out of work and get injured less, stay out of work for less amount of time. But is that compelling? Not totally clear, because the decision to self-insure is endogenous. And so maybe it's the types of firms where injury risk is not that high, you're not in some very risky occupation, you choose to self-insure and you're going to get this pattern, right? So I would say empirically, we don't really know how big these effects are, and we haven't had really compelling quasi-experimental analysis of this issue. So because workers' comp is a mandated benefit, the third part of this literature where people have done some empirical work is related to the Summers '89 paper that we talked about early on. So what do we expect to see if workers value this workers' compensation benefit? Well, when firms hire, we should see that they adjust the wage downwards to account for the fact that they're giving you this benefit, right? And you remember, you can figure out how much workers value the benefit by figuring out how much wages drop in equilibrium. So Gruber and Kruger have a paper testing the Summers predictions in the context of workers' comp using changes in workers' comp laws. And so they say when workers' comp benefits go up by $100, do wages in fact fall by the expected amount of workers' comp benefits that you're going to get given injury rates, right? And they find that 85% of the additional cost that firms bear because of the increase in mandated workers' comp benefits is in fact shifted to workers, and there isn't much of an impact on equilibrium employment, suggesting that you're very close to that Summers case of alpha equals 1, where the workers value the benefit at cost, and so the supply curve shifts out to the same extent that the demand curve shifts. And so wage drops 1 for 1 and employment doesn't change. And then there's another study by Fishback and Cantor who studied the initial implementation of the program. So this is an historical paper using data around the 20s when the program was implemented. And they also find a 100% shift to workers' wages. So it looks like this mandated benefit actually is working pretty well in the sense that workers are valuing it basically at cost. It's not having distortionary effects on employment, and is providing insurance. Now, there is, I think, growing concern that there's quite a bit of moral hazard in the workers' comp program. And I remember when I was in California, this was a big deal where the state was spending more and more money. Companies were spending more and more money on workers' comp benefits. And this was viewed as putting California at a competitive disadvantage relative to neighboring states which had lower workers' comp benefits. And so, I think that's a question that's not quite resolved. What are the moral hazard costs of this program relative to the benefits of the program? That's basically, I think, what we know very little about. So, if you're interested in doing empirical work on workers' comp, what are some directions? So we've seen from the Meyer et al. Paper that people take longer to come back to work when you give them more benefits. But as we've talked about, that could be due to a combination of liquidity and moral hazard effects, right? And so that's embodied in your question of, are people coming back to work too quickly? Well, one way to think about that is if they had enough cash to take longer to come back to work, so just they had more liquidity, would they take a longer duration? Or are they taking a longer duration just because their incentives to work are distorted, in which case you want to scale back the benefit, right? So one way to go about it is an outcome-based approach, which is to ask things like, are they more likely to get injured once they come back? But the limitation of that approach, as I've talked about before, is that there are many, many different dimensions of outcomes you might care about, like how likely they are to get injured in the future, but also consumption smoothing benefits and various other things. And this, if you could get at the liquidity effects, you could in principle figure it out. Now, one strategy actually that's suggested by the type of variation we see in the policies is the permanent injuries pay out benefits as a lump sum, so they do not distort your marginal incentives. So in principle, that would be something one could look at. You could ask, if you got a bigger lump sum payment for some injury in state A instead of state B, does that affect how long it takes for you to come back to work? And in principle, maybe you can do some decomposition of these effects using that approach. The other area where I think we have very little evidence is on how important these firm-side responses actually are, the safety. Okay, so the workers' comp literature, for whatever reason, has not really been tremendously developed. But there's actually pretty good data. So I think if you can obtain broader theoretical insights from studying this program, that's an interesting thing to work on. Okay, so the literature that actually has been much more active recently and has generated a lot of policy debate as well at the national level is disability insurance. So there's a lot of work on disability. There's a handbook of labor economics chapter that covers some of the empirical work. What does disability insurance do? It insures people against long-term shocks that affect you either at home or at work. Okay, so it's different from workers' comp in the sense that it doesn't matter where you get hurt, and so it's not a workplace program. It's not about workplace injuries, and it also has medical benefits and wage benefits, which are part of the Social Security program. So your Social Security tax partly funds DI benefits. And basically the way to think about DI is that you become eligible for Social Security early at whatever your Social Security benefits would have been, depending upon your earnings history and so forth. So the idea of the DI program is that you're eligible for it if you're unable to engage in substantial gainful activity because of a physical or mental impairment for at least 1 year in expectation at the point that you apply. So you can see that this is a very tricky definition to, it's tricky to say exactly who is eligible for DI and who's not. It's not like a bright line. And that makes DI, that's I think the key distinction between DI and unemployment insurance, where we think it's relatively clear who's unemployed and who's not, aside from reporting issues like we were talking about, especially in less developed countries where people might be working under the table. If you ignore that issue, it's clear what unemployment means. It's not quite clear what disability is. And that affects the nature of the theoretical models, as we'll talk about in a second. So the main focus of the DI literature, the reason I think people have been so concerned about it, is the sharp rise in the size of the program. So going back even to the 60s, but this graph here starts in 1989, but the trend goes further back. You see that there's a tremendous increase in the caseload that is the number of people on disability insurance, right? So look, today, I mean, it's actually quite stunning that you have nearly 10 million people in the US on DI, right? And that trend is just, looks almost linear. So you're going to have a huge number of people on DI going forward. And at the same time, you see, if you take data from the CPS, the employment rates of people who report having a disability versus people who do not report having a disability, they are steadily declining. And as I was saying, this goes back. If you extend this graph to the left, there's a paper by Parsons in the early 80s that does this. You see similar time series trends, right? So the key question is, are these two things related, right? So are the people who are employment rates among people with disabilities falling because DI is becoming more generous, because benefits are going up, because we're expanding the set of conditions for which you're eligible for DI? Okay, so there are two views on the rise in DI. The first, which is I think what people thought, especially traditionally, is that this is basically moral hazard from a lenient system that's leading to inefficiency. Like a bunch of people could be working, and maybe they should be working, but they're not because their wages are distorted. But a different perspective, exactly as you said, is that you had several people who had to work in order to make a living. I mean, you have to do something in order to generate income. And their disutilities of labor were really high, but they were forced to work because of an income effect. And so they were inefficiently working. And so the increase in DI, even if it was caused by the changes in the program rules, is maybe a good thing. I say empirical work attempts to disentangle these views, and I say attempts to because I think it does not actually get to the normative question. That I think is actually precisely where important work remains to be done. All right, so here's why you have a problem in DI that's different from UI. So this illustrates the fact that it's very tricky to figure out who is actually eligible for DI and who's not. And so this is an audit study that establishes that by taking a set of people who had an initial review by the Board of Disability Examiners, okay? And they were initially determined to either be allowed to get DI, to be eligible, or their case was denied. And then to test whether the system is working properly, they took the same set of cases, 500 cases, and they gave them to a different set of medical experts and asked them, are these people eligible for DI or not? So if you're able to perfectly figure out who's DI eligible and who's ineligible, all the math should be on the diagonal, right? Everybody who was allowed initially should be allowed the second time. You look at it's the same exact file, right? And similarly for the denials. Okay, so you can see that in fact, there are a significant number of type 1 and type 2 errors, roughly 20% for both. So there's quite a bit of disagreement even among the experts themselves who are presented the same information about whether people are eligible for disability insurance or not. So you can see why there's quite a bit of scope then for moral hazard where as a worker, it's quite ambiguous whether you might be eligible or not, and you might change your behavior depending upon the incentives. So that leads to the key additional element of the theory of disability insurance relative to UI, which is screening and waiting periods or hassle costs, basically. So in DI, it's beneficial to have a screen in a way that is not really relevant in the context of UI because you know who's employed and who's not. So the paper that addresses this theoretically is by Diamond and Shashinsky in the JPAB in 1995, where they build a model of social insurance that incorporates this screening decision as well. And what they do is characterize the optimal properties of the solution. So it's kind of like the Merle's analog here, where they give you a bunch of first order conditions for the optimal solution, but they don't derive an empirically implementable formula for either the optimal screening rule or the benefit level. So you get some theoretical intuitions about what the policy should look like, but it's hard to say empirically what the optimal level of benefits is. And so this then I think is a natural area to try to develop something where you can connect the type of empirical work that I'm going to show you to their model. I think nobody's done that yet. So here's like a super simplified version of their setup. You have people with heterogeneous disutilities of work, psi. In order to maximize social welfare, what are you trying to do? You're trying to basically have the people who have very high disutilities of work take disability insurance and not work, and the people with lower disutilities of work, you want them to work, right? So in the first best, individual I is going to work if his marginal product, his wage, if there are no other market imperfections, exceeds his disutility of labor. The problem is that the government observes only an imperfect signal of the individual's disutility of labor. And so they're going to set a stricter screen. They're going to want to give give DI to fewer people than you would in the first best, all right, for incentive reasons. and you're not going to give perfect benefits. You're not going to give perfect insurance, because if you did, then everybody would be trying to claim the DI system, right? And the main theoretical result of the paper, which is very intuitive, is that if you have a better screening mechanism, that is, if you come back to this chart, one way to think about it is if you make smaller type 1 and type 2 errors, then you want to provide higher, the optimal benefit level is higher. So that makes sense, right? If you have a better ability to figure out who's actually disabled and who's not, then you're going to want to provide more benefits. And you can see that if you can perfectly figure out who's disabled and who's not, then you converge to the first best, right? So what I think would be interesting is to figure out if you can tie these measures of type 1 and type 2 errors and the types of elasticities of how DI affects claiming behavior and employment rates to a prediction about what the optimal benefit should actually be. Okay, so let's talk about the empirical literature. So the first question is just, as a fact, it's sort of like measuring the uncompensated elasticity. Did the increase in disability benefits cause a decline in labor supply? And then we'll talk about, and we don't really have any evidence on, but as I've been saying, you want to figure out whether that's because of an income effect or a price effect. But that's not what we're discussing here. So there's a well-known debate about this question between John Bound and Don Parsons in the 1980s and early 1990s that's of interest in the DI literature, but actually I think is of greater interest methodologically because it had a big impact on the way empirical work is done in applied microeconomics. So Parsons, in a paper, I think in the JPE in 1980, does the following thing. So he uses cross-sectional variation in replacement rates. So precisely because of the fact that DI benefits depend upon your past earnings, you're going to see that some people end up being eligible for higher DI replacement rates than others. Okay, so you might get 60% of your past income, and I might get 30% of my past income when we claim. So he uses a data set from the 1966 to 69 NLSY on men aged 45 to 59. So usually people focus on slightly older individuals where the claiming rates are a little bit higher, and you'd be eligible for the program. And he runs an OLS regression that looks like this, where he regresses an indicator for whether you're participating in the labor force, whether you're working, on the DI replacement rate that you are eligible for, and some controls, which we'll come to in a second. The DI replacement rate is calculated based on your wage in 1966 at the beginning when he sees you here, before you're filing this claim, all right? He runs that regression just using cross-sectional variation in the replacement rate and finds an elasticity of 0.6. And then he runs a bunch of simulations which says that, which show that the increase in DI benefits that occurred over the past 20 years when he wrote his paper, so from 60 to 80, can completely explain the decline in labor force participation among older males. So the idea of this paper, and the reason it was really important, is it's arguing that the rise of the social safety net is dramatically changing work patterns in the US and making people work less, right? So John Bound in these papers in the late 80s highlights what is now obvious as a key econometric problem in Parsons' specification, which is that the DI replacement rate variation he uses is correlated with the wage, obviously, right? That's what's generating it. And so what's the identification assumption Parsons needs for to get a unbiased estimate of the causal impact? He needs that labor force participation rates would be equal across these high and low wage guys in the absence of DI, which doesn't really make sense because we think that wages should be one of the prime determinants of whether you want to work or not, right? So the Parsons response to that, and this is where this is, I think, really the important point, is that let's control for the wage rate. Okay, so I'm willing to give you that wages might have a direct effect. So let me control for wages by including wages in this regression. And I think the key insight here, the key conceptual advance, is figuring out whether controlling for the wage in that way resolves the problem or not. Okay, and this comes to what we call identification by functional form, and what the problems are with identification by functional form. So think about the logic of the Parsons specification. So the way he would implement it is, say, control linearly over the quadratic function for the wage rate, right? So that exercise is what we call identification by functional form. Why is that? Because as I make f here more flexible, so suppose I make f a cubic, quartic, so eventually I make it a non-parametric function, right? Then what's going to happen to the coefficient on beta? The standard error on that coefficient is going to go to infinity, right? Because there is no variation in the replacement rate that is unrelated to the variation in wage rates. The only reason replacement rates vary across people in his sample are because wage rates vary across people. So if I control sufficiently flexibly for wages, I have no identification left. So the only reason that you're identified in a regression that, quote, controls for wages linearly is by functional form, in the sense that you are saying, implicitly what you're saying is, I know the relationship between labor force participation and wage rates has to be linear, and I'm going to use deviations from that linear trend in order to identify the coefficient beta. But that is a super strong assumption. How do you know that the relationship between labor force participation and wages is linear or is, quadratic or whatever, right? Could be any smooth function, you would think. And so, I think that led people to realize that this actually doesn't make sense, that you actually need to have some other source of variation that's totally orthogonal to the endogenous variables that matter for the outcome of interest, okay? To illustrate the practical importance of that point, one of the nice things that Bound does in his paper is that he replicates Parsons' exact same regression specification on a sample that never applied to DI. So clearly for these people, DI is not the reason that they are working more or less, because they never applied for DI. And he shows that you get exactly the same elasticity. It's because you're not actually picking up the causal effect of the DI replacement rate. You're picking up some nonlinear effect that wages are having on labor force participation, right? So that motivates the literature that we've been talking about that was developed over the 90s and the 2000s that focuses on quasi-experiments or other sources of non-parametric identification. One thing that I just want to use this to be clear, so what's the importance of non-parametric identification? It's not that you don't put any parametric forms on the equation you're estimating. So typically when we do like an RD, we have some cubic control function, or many of the quasi-experiments, in the end when we implement it, there's some parametric form. But the key idea of non-parametric identification is that if you had a sufficiently large sample, the estimate could potentially be identified without any parametric assumptions on any of the functions. So you could just allow all of these functions to be arbitrary smooth things, and if you had enough data, you would still be identified. The problem arises if your research design is such that if you allowed for arbitrary smooth functions of all the other variables that are relevant, you lose identification, okay? And so, the way I like to think about it is we impose functional forms only for computational convenience or to obtain precision in finite samples. You don't want to be imposing functional forms in order to be identified, okay? That's, I think that's the way you want to think about this. All right, so what does Bound actually do constructively? So the first thing, the important thing is the critique of the earlier approach, but he also proposes a technique to bound the effect of DI on the labor force participation rate that's quite intuitive. He uses data on the labor force participation of rejected applicants as a counterfactual. So here's the idea. If rejected applicants don't work, then surely you would think that the DI recipients themselves, who, if at all, should be even less healthy, would not have worked, right? So as long as you think the disability examining board is doing a somewhat decent job of identifying the people who are more sick, then you would think that the probability that you work is declining with your health, and hence the people who get denied their claim, they're not getting DI benefits, so they should give you an upper bound on how much the other guys who are getting DI benefits would have worked in the absence of DI, right? So he has some data demonstrating this technique. I'm going to talk about this paper by Maestas, Mullen, and Strand that's just coming out in the AER, which does a similar exercise and does some other things. So, so this is tracking a bunch of people using Social Security admin data and using a measure of whether they're employed. Do they have SSA covered earnings of more than $1,000 a year? Take a bunch of people who applied for DI in year 0 here, and look in the panel. So there's an event study around that application of the fraction who are employed, and break them into 4 groups. People who are initially allowed, people who are initially denied and then allowed on an appeal, so there's an appeal process. And then there are people who are initially denied and denied on the appeal, and people who are initially denied with no appeal. So let's compare the people who are denied in the red series here with the people who are allowed in the blue series. And what you can see is for everybody, the employment rates are falling off right before the application. That makes sense, right? I mean, you're going to apply for disability at a time when you're not doing as well, and that's when your employment rates might fall naturally. What we want to know is these people who were allowed disability insurance, the guys in the blue, how much would they have worked if we did not have a disability insurance program? Well, the idea of the bound strategy is we can say with quite a bit of confidence that they probably would not have worked more than this red line here, because those guys are not actually getting DI and they're healthier than the group in the blue. Okay, so that's, as we've been talking about, these questions have raised, that gives you a bound, but doesn't actually tell you it doesn't give you a point estimate of the impact of the program, right? So why do we have much less empirical work on DI than on the other programs traditionally? It's because DI is a federal program, it's not a state program, so you don't have the type of variation that you have for workers' comp. So I'm going to talk about 2 papers. First, I'll briefly talk about this study by Gruber in the JPE in 2000, which turns to Canada, where you can do the diff and diff, unlike the US. I'm going to be very brief here because this is just like the standard diff and diff thing that we've talked about many times. So it turns out in Quebec and the rest of Canada, they have different DI provisions prior to 1987. In 1987, benefits were increased in the rest of Canada, kept relatively constant in Quebec. Gruber uses that quasi-experiment to estimate the effect of the law change on labor force participation of men 45 to 59. And so this is a graph of the first stage. You see the sharp rise in benefits for the rest of Canada relative to Quebec. What Gruber then does is does the diff and diff table of non-employment rates in the rest of Canada before versus after, in Quebec before versus after. And you can see that non-employment, the fraction of people who are not working, rises in the rest of Canada relative to Quebec by an estimated 2.7 percentage points. That is not very precisely estimated because you can see the confidence interval comes very close to including 0, so you don't really have a good feel for what exactly the impact is. And if you were doing this now and you had better data, you'd really like to draw this graph with labor force participation rates and not do that table, right? So I've made this point a few times in this class. So so what do you get out of this? An implied elasticity of the non-employment rate with respect to the DI benefit level of about 0.25 to 0.3. Seems to be more in line with Bound than with Parsons, who had higher elasticity, so you can't explain the whole decline in labor force participation for older people just through the increase in DI. But the estimates are imprecise, and they only capture short-run effects, like a year after the policy change, what happened to employment rates, all right? So the paper that I think that I'm much more excited about, this is the one that's just coming out in the AER. There are a pair of papers that do this in the US using a research design that I think is going to be much more popular going forward and gives us a much better handle on what's going on. So in this paper, they use random variation in examiner assignment to identify the effects of DI. So remember I was showing you in the initial table that it matters which set of doctors are looking at the claim. So it turns out that which set of doctors your case is assigned to is basically random. It's like a queuing thing, and it just depends upon when you show up in the queue. And so the computer randomly assigns you to examiners at the state board, and because there's substantial discretion, there's significant variation across examiners and allowance rates. So they instrument for the probability of DI receipt with examiner fixed effects. We'll talk about that in a little bit more detail in a second. And then they have really good data. So this paper, I think, is like an illustration of frontier AER paper at this point on a topic like this. So good research design and excellent data, administrative data on DI receipt and earnings from the SSA with 1 million observations. Okay, so here's the key graph from the paper, and then we'll talk about how you quantify the impacts. So you've got these examiners, each of whom, for whom we can compute an allowance rate, and they say residualized because you've got to adjust for some, it's conditional random assignment. It's not literally random, it depends upon which state you're in and so forth. So you can isolate the random component of the allowance rate for each examiner, all right? And then this left graph here is the first stage, which at some level is mechanical. Some examiners are less likely to give you DI than others, and then they're just showing you that your own case, you are more likely to get DI than if you get this examiner down here who has a relatively low acceptance rate relative to the mean. One thing to note here, if you look at this, the slope of this thing, if you perfectly measured each examiner's effect, should actually be 1, right? Because you're just regressing the probability you get DI on the average propensity that that person, that examiner gives DI. It's actually less than 1, and that's because there's noise in the estimation of the treatment effects of each examiner. So if you have a small number of cases in particular for each examiner, then I'm going to, by chance, in a separate set of data, estimate that this guy has a high allowance rate versus a low allowance rate, and that's not going to one-for-one predict whether you get DI or not. Okay, so that's why you would think that this should be totally mechanical. If you're assigned to a person who has a 1 unit higher chance of giving you DI, you should get DI with a 1% higher probability. It's less than that because of that noise in the first stage. Okay. But the point is there's a very strong relationship. Ideally, I would have liked to see this, as just like a bin scatter plot so you can see the variation in the data, but they're plotting confidence intervals. You can see that this is a very strong relationship. Okay, so you're randomly assigned to these examiners. The probability you're getting DI is varying, and then they look at employment rates afterward, and you can see exactly as you would predict, consistent with the hypothesis that DI reduces employment rates, the guys who randomly get these examiners who approve more DI cases are less likely to work. And they're a few percentage points less likely to work. We'll talk about how you quantify the impacts in a second. But about a 6 percentage point effect if you move across the spectrum, right? So that's the research design. Let's now talk about how you quantify the causal effect of obtaining DI on employment rates. So they use IV regressions, which they estimate with 2-stage least squares, in which the first stage looks like this. So you regress each person's probability of getting DI on a dummy for which examiner they got. And what you're estimating here are each examiner's fixed effect, right? So that's basically going to recover the mean probability of DI approval by examiner. The second stage then regresses the outcome, like earnings or employment, on whether you got DI or not, and we're instrumenting for DI using these examiner fixed effects, right? Yeah, Jessica.
Do you have to use a mean out?
I'm going to talk about that in a second. That's exactly the interesting econometric issue here. Okay, so what are the first stage coefficients? The phi-i's are just average DI allowance rates by examiner, right? That's what you're going to get mechanically when you run this first stage regression, though that's the best fit. So the IV regression then is equivalent to the examiner level OLS regression that looks like this. So I can get this coefficient beta if I just run this OLS regression, where the left-hand side is mean employment rates for each examiner regressed on mean DI allowance rates for each examiner. And if you weight that regression by the number of individuals that each examiner has, then you're going to literally recover the coefficient that you got here. Okay, so you can work that out algebraically. So that's useful, and that's going to come to the leave-out mean point that we'll talk about in a little bit. All right, so think of this as essentially correlating average DI allowance rates with average employment rates by examiner. Okay, so here's what they actually get when they run those IV regressions. So look 2 years after the decision. The outcome is whether you're employed. Are you earning more than $1,000 a year? And this estimate here tells you that you're 28 percentage points less likely to be working if you got DI relative to not getting DI. And you can see that's quite precisely estimated, t-stat of 8. And that 28% number, if you think back to the graph that I showed you with the blue series and the red series, you're pretty close to that upper bound, right? It says that of the people who get denied DI, they look pretty similar to the guys who got denied in OLS, right? That is close to the upper bound effect from the John bound approach. What's also nice about this is you can look at it over time. So do these people start to get back to work over time? Or do the employment effects grow? If anything, they get smaller. So it's 28% here, 22% after 3 years, 16% after 4 years. Okay, so in the longer run, it does not look like DI is having a massive effect in terms of reducing employment rates, at least not anything close to like 1-for-1, for example. Now, what I think is quite interesting about this is the following. So they conclude that DI receipt reduces the probability of employment, as I was saying, by 28%. But they're careful to note that that's for the marginal applicants. So this paper illustrates well why local average treatment effects are different from average treatment effects and might be different from the treatment effects you care about for policy. So who are you manipulating here when you use this instrument? So if you think about it intuitively, this is a late for people who are at the margin of being approved or disapproved by these examiners, right? So there are going to be some people who just have like a really severe illness where every examiner is going to agree this person is eligible for DI. And then there are going to be some other people who are clearly ineligible. The people you are treating with this instrument are the guys who would have been granted DI by some examiners and not by other examiners. So you would think those are cases that are relatively less severe, basically, right? And so that local average treatment that you're estimating should, they point out, I think quite correctly, should be interpreted as an upper bound on the average treatment effect. So that is, if we really care about how much did DI reduce labor force participation rates for the average person who is claiming the program, these 10 million people, how much would they have worked if we did not have the program? It would probably be much less than 28%, right? And they confirm that by studying the heterogeneity in treatment effects by disease severity, where you see a pattern that looks like this. So they look code by code at what type of condition you're applying for, okay? So like a mental disorder, cardiovascular disorder, respiratory system, and so forth. And you can do this exact same analysis they have enough data that you can do it by subgroup, right? And you can see exactly as you'd expect that for conditions that are extremely severe, so like take this respiratory system one, for instance, if you're not able to breathe, presumably you're not able to function in any job very well, and you see very small employment effects. If you're denied with that condition, you hardly are working anymore if you don't get DI versus if you do get DI. Whereas for other conditions, In particular, like mental health disorders, one of the highest ones, you see a 36 percentage point effect, where people would have, it suggests that there's a significant amount, possibly of moral hazard or something else going on that's making people much more elastic with certain conditions relative to others. And then if you take this a step further, you can sort of say, there's a conceptual issue here of whether you're actually able to identify the treatment effects of people who are so severe that they never get denied, because they're basically not going to show up in this table, right? But setting that aside, so assuming sort of that you have some support for the entire distribution, like there's a little bit of chance that some examiner would turn you down throughout the severity distribution, then you can imagine how you could integrate over this type of thing and figure out what the average treatment effect looks like. Okay. Questions? Yeah. Are there positive significant coefficients here? I mean, so this one here, for instance, they just have no data, right? The t-stat is 0.59. The confidence interval is includes a lot of stuff. You basically have no observations. Yeah. I don't think you see any positive statistically significant coefficients, actually. So this ties well, I think, with some of the themes of this class. The results, in my view, highlight the importance of estimating the relevant weight for the policy question you're trying to answer. So if your policy question is, should I raise DI benefits or not, then the relevant treatment effect is for people on the margin with respect to the benefit change. And that may not be the same people who are on the margin with respect to the examiner's decision, right? It's a different local average treatment effect. And so, in my view, that's the advantage of directly studying the policy of interest. So if you map this back to the sufficient statistic type of logic, what you'd have to do here is extrapolate from the weight that you're able to estimate to whatever the weight would be if you changed benefits. If you just directly changed benefits and saw what happened to employment rates, then you would have exactly the parameter you want for the welfare analysis. Okay, so there's value in estimating the weight using the policy variation that you're interested in studying. The other point, limitation of this study, and I think it opens up scope for future work, is that this just estimates uncompensated elasticities, right? So as we've been talking about, it's critical to distinguish moral hazard from liquidity, or to put it differently, to quantify the benefits of the program for normative purposes. So even when you're rejected, you see a lot of people working, but those people might be working with a disutility that's above their marginal product, because they're working just because they have to have some money in order to survive. And it's not clear that the 30% of people who would have gone back to work, maybe we only want 15% of those people to actually be working. So I think disentangling that is definitely an interesting thing to figure out. So let me now come to the leave one out point. And as a bit of an aside to this paper, talk about this issue of weak instruments. So the approach taken in this paper, I think you're going to increasingly see in many applications. So for instance, we have a job market student this year, Will Doby, who's using random assignment to bankruptcy judges who, again, there are judge fixed effects, and then he uses that to evaluate the effects of bankruptcy and outcomes. You see similar applications in education, like in our Project STAR paper, where we studied long-term impacts of kindergarten class assignment. Same sort of thing where you're randomly assigned to some group, which then has impacts that you estimate with an instrumental variables framework. So a common problem that arises here, as well as in many other IB applications, which you've heard about in an econometrics class, is a weak instruments problem. And I just want to talk a little bit about that here, because you get some good intuition, I think, from these kinds of applications on why the problem arises and how you solve it. So when does the weak instrument problem arise? The key issue is when each examiner has very few cases. This is actually not an issue in the Maestas et al. Paper, because in their case, they have a lot of cases per examiner, okay? But it's common in many other applications, like where I started thinking more about these issues, is in the Project STAR application, where you have about 20 kids per class, okay? So you do actually have small number of individuals per treatment. in this case, the weak instruments problem is that IV will be biased towards OLS. So why is that? So let's start by going back to the OLS version of the regression that I had described. This is why I put that up. Recall the examiner level OLS regression that's going to recover the same IB coefficient, where I regress average employment rates for each examiner on average disability allowance rates by examiner. Okay? What is the fundamental problem here? The same observation appears on the left-hand side and the right-hand side of this regression. So your employment rate, whether you work or not, and whether you got DI or not, are there on the left-hand side and the right-hand side. So what's the OLS regression? OLS regression is just when I regress your own employment rate on whether you got DI or not, right? So you can see that this regression, when I look at it at the employer level, it has a little bit of the OLS regression in it. In particular, if you have very few individuals, you're going to get biased towards OLS. So take the extreme case. Suppose you only had one guy examined by each examiner. So there was only one individual per examiner. Then obviously this regression would be exactly the same as the OLS regression. Now if I have two people per examiner, it's better, but I still have 50% of the variation coming from the fact that coming from myself. And myself is what's generating the OLS coefficient, right? So what that does more generally is if an examiner gets a draw of particularly sick people, like in the DI application, then those people will both be likely to get disability insurance. Like let's suppose the examiner gets a lot of people with these respiratory conditions, just by chance. They're all going to get DI, and they're all not going to be working because they're really sick and they're not going to be able to work anyway. So you're going to conclude that DI has a huge effect on employment rates using the IB strategy, even though it has no causal effect, possibly, right? So that problem is going to vanish as the number of individuals per examiner grows large, because the only remaining variation in DI bar E, the average disability allowance rates across examiners, is going to be due to examiner effects as opposed to random sampling variation in a finite sample. So the key question in the weak instruments literature, which I think I only really understood well after working on the STAR paper, is does the number of instruments grow at the same rate as the sample size? So if you make your sample bigger by adding more people per examiner, then your instruments are going to asymptotically be strong. And the way to think about that intuitively is the one guy's contribution to this mean basically is irrelevant, right? If I'm in a kindergarten class of 1,000 people, the fact that I'm in that average is basically irrelevant because the average is driven by the other 999. If I'm in a kindergarten class of 10 people, each observation actually has significant influence. And so if the way I get a bigger sample is by adding more examiners, that is, if I grow my sample by adding more instruments and more observations at the same time, then my instruments are asymptotically weak because I'm not solving this problem in the limit, right? So that's why when people say it depends upon what the asymptotics are, the way to think about it is if the asymptotics are n grows large relative to the number of instruments, then you're good. You can do two-stage least squares. If you have the number of instruments growing at the same rate as your sample size, which is typically going to happen in a lot of applications because the way you get more data, like in education, is you look at more schools or you look at more classrooms or you look at more judges or whatever, right? Then you're going to have this problem. Okay, so last thing on this, how do you fix it? Yeah, go ahead. Okay, so how do you fix the problem? So traditionally, what people would recommend doing, like what you'd see in econometrics class, is to do LIML, limited information maximum likelihood estimation, which intuitively, sort of like the way it works, it's hard to figure out intuitively actually exactly what's going on, to be honest. But you're reducing the number of parameters that you're estimating. That's one way to think about it. And so as a result, the number of parameters you're estimating is not growing at the same rate as the sample size. And so under certain assumptions, you recover a consistent estimate. I think the preferred alternative, which sort of is stuff we've been doing here over the past couple of years after our STAR work, and Hito, Imbens, and Michael Kolasar have been working on this, is a jackknife IV. So this is exactly what Jessica had anticipated. You want to leave out your own observation for each individual I when estimating the first stage. That is, when estimating each examiner's effect. So in other words, you make the second stage regression your employment outcome on the DI allowance rate of everyone else except yourself. And that actually is a totally intuitive way to solve the weak instruments problem, right? Because you're directly taking out the same observation on the left-hand side. And so Michael Kolestar is one of our job market students this year. His thesis is about how the jackknife estimator has more attractive properties than Limmel. All right, so the last paper, which I don't quite think we'll have time to get to, but let me just say a word on this, is that I want to talk about is by Otter and Duggan. So the reason I end with this is we've talked about each of these social insurance systems separately, like as if they just exist on their own. But in reality, there are actually interactions between these systems that I think can be quite important. And the paper by Otter and Duggan on DI highlights that nicely by focusing on the interaction between DI and UI. So they observed that DI claims rise in recessions, and they point out that that might reduce the measured unemployment rate and make you think the economy is healthier than it actually is. So here's the idea. So let me just describe this and then we can wrap up. Let's consider a worker who's laid off in the current recession. Given the generosity of the DI program, what you might do is instead of claiming UI and searching for a job, which is what you might have done in the 1980s, today you might think, okay, maybe it's better for me to apply for DI. So what's going to happen? The requirement for DI is that you're not looking for a job. So when they come interview you in the CPS and say, are you looking for a job? You're going to say no, right? And so the unemployment rate is going to look lower because you've got one less unemployed guy, one less guy who wants a job but doesn't have one. But the economic situation is exactly the same, right? You have one less person who is working than who could be working if we weren't in a recession. And so what Otter and Duggan do is present evidence that this is actually an important phenomenon and an increasingly important phenomenon as DI has become more generous. So we'll talk about that next time. Okay, so let's start. So today we're mainly going to talk about externalities and public goods, but I just want to wrap up on the social insurance part with this last paper, which is the Otter and Duggan paper about the interaction between the DI and UI programs. So we talked about this slide at the end of the last class where the expansion of DI might lead us to understate the unemployment rate in the current recession. And so let's see what that looks like graphically. So this is taken from a paper by Mark Duggan and Immerman in 2005, which just shows you the time series of DI applications over the business cycle. And you can see, if you look at the first part of this picture, which is the Otter and Duggan point, there doesn't seem to be that much of a relationship necessarily between the DI application cycle and the business cycle, the changes in unemployment rates. But then when you start to look at the later periods, especially after the mid-'80s when there was this big change in the DI program that made it cover more conditions, it starts to look like these things are more co-integrated, right? They're moving together. So that is suggestive. Of course, by itself, I wouldn't say it's convincing that evidence that increases in unemployment rates are driving up DI applications, but that's exactly what Otter and Duggan try to do using state-level variation, establish the connection between business cycle conditions and unemployment rates more directly. So the method they use is a standard instrumental variables approach that's used in many, many applications that goes back to a paper by Tim Bardick in 1991. So those of you who are taking labor class would have surely heard about this. So let me just describe how it works in this application. So you want to get state-level measures of changes in economic conditions, of say changes in unemployment rates. You don't want to directly use the state-level unemployment rate because you're worried that it might be driven by some other factor idiosyncratic to that state, like let's say the decline in the housing market or something like that. And the decline of the housing market could be through other channels associated with DI applications, and so that you would then have a confounded estimate. So you want to isolate sort of variation in state-level unemployment rates that's not due to idiosyncratic state-level factors. So the standard way people do that is by first, you do it in a series of steps. The first calculate industry shares in a given state in the base year, like let's say 1990. So what fraction of the state is in the auto industry, what fraction is in, each industry, right? Then calculate employment changes over some period, they use a 5-year period, by industry, using data on national employment, okay? So this is the key thing, that you're using national employment changes. And if you want to link it to what we were talking about at the end of the last lecture on weak instruments and jackknife IV, the natural thing to do if you're worried that, like if you include California itself, the employment shares in California are going to play a big role in the national changes, right? So you might exclude the state in question. That'd be the leave-out mean approach. And then you project changes in each state's employment using the national changes. So you say, in Michigan, there's a lot of auto industry stuff. The auto industry in the nation declined. We're going to assign Michigan a big negative employment shock, right? And so then so now you've constructed the instrument, and then the last thing they do is correlate these state employment shocks with DI applications. And what the paper focuses on is doing that in separate periods. So they're going to show you how this relationship changes over time. So x-axis is basically the instrument that I just described. And y-axis is the number of DI applications per person. And this is done from 1979 to 1984 in this chart here. And you can see this relationship looks relatively flat, right? You don't find a significant relationship between these two variables. So now do this in 1984 to 1989, starts to look more negative. 1989 to 1994, and then the last period in their data, 93 to 98, you see the relationship is starting to pivot downward more and more. And by the end, there's a very clear negative relationship where if you're in a state that got hit with a hard negative shock, DI applications really go up a lot. And so their point, this supports their main argument that the expansion of the disability insurance program is reducing the unemployment rate artificially. And so by their calculations, unemployment around the time they wrote the paper would have been 0.65% higher, if not for the post-84 expansion of DI. So, quite a non-trivial change. I mean, if you think about like in the current policy debate, if the unemployment rate was 8.6% instead of 7.8%, that could have had a big impact on, various things, including the election, I think. So, that's just from like a measurement point of view. And so, why is it changing over time? It's because of the 84 inclusion of mental illness. They think, and they don't have direct evidence of that, but they have evidence that it's changed over time. And possibly the fact that benefits have effectively gone up over time, not so much because we have raised replacement rates, but because the system is progressive and wage inequality is increased. So in essence, that's going to make the average replacement rate go up, right? Because you've got more guys in the part of the distribution where you get high replacement rates. So the person-weighted replacement rate has gone up. So one point is about measurement, but the other point, which I think people are starting to think about more, is normative. That is, when you think about optimal DI benefits, you clearly need to think about the impacts on the UI program, right? And so here this is actually sort of a beneficial effect insofar as when we expand DI, we have less of a fiscal cost in UI because you've got fewer guys claiming unemployment insurance, right? And likewise, when you expand unemployment insurance, there's going to be a spillover fiscal externality effect on the DI program. So what I've been seeing very recently is a set of papers that try to think about how that affects optimal benefits. So rather than thinking about optimal policy for each program separately, thinking about it jointly. So there's a paper by Urzo Lutmer at Dartmouth using data, I think, from the Netherlands, where they document similar effects where one program is expanded. Naturally, you see less people on other programs, and they quantify the size of these fiscal externalities. And then I think there's a Princeton student who's extended the types of formulas we talked about for optimal insurance, like the Bailey type stuff, to incorporate fiscal externalities across programs. Those fiscal externalities are really important because they are first order responses, not second order, right? There's no optimization there. every extra guy who's on UI, that's just cash that you are spending that was not taken into account, not enveloped away in some optimization problem. And so that's going to have a really big impact on optimal benefits, much more so than incorporating like other types of behavioral responses and stuff like that. So what's the bottom line here on DI? It's clear that DI applications, I think, are sensitive to incentives. We've seen a couple of very good empirical papers that document that. But I don't think we know enough yet to say whether the fact that more people are on DI as benefits are increased is a good or bad thing, and whether we have benefits that are too high or not. So clearly that's like an area where a major contribution remains to be made. Okay, questions? Okay, so that's it on social insurance. Now we